Liquidity ratios help investors understand if a company has enough cash to pay its bills. Let's look at how they work. Liquidity is simply how easily a company can turn its assets into cash to cover short-term debts. A ratio of 1 is a common baseline. Anything below that may indicate the company is struggling to pay its immediate obligations. Analysts use different formulas, depending on how strictly they want to measure the company's ability to pay off debt. The quick ratio is more conservative because it assumes inventory might be hard to sell during a financial emergency. Watching these ratios over several years helps identify if a company is becoming more or less efficient with its cash management. Finding the right balance is key. Investors look for companies that manage their cash flow responsibly without hoarding it unnecessarily. Understanding these metrics is a great step in analyzing financial statements. Subscribe for more basics on how companies report their health.